Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Welcome to this, our last Market Carver for the first half of 2022. We do continue to see all sorts of heat around us, both literally outside and temperature-wise, as well as internally in various markets. So kind of a slow, steady decline that we're still in the midst of. So hopefully give you some of our current thoughts and continue to keep you updated on exactly what we see unfolding. And so much of the attention is now on stocks, at least at this point in the year. But just before we start, bonds will actually be the first point that we hit. Just a quick update on some significant flow activity. But then we'll also look at grocery stocks and an update on 52-week lows, something I know Andrew has told you guys about a few times and how critical that is for marking turning points in the cycle. So we'll start off with the fund flows out of bonds. So several things have been unique about this environment. On the stock side, we haven't really seen a mass hysteria or huge amounts of volatility. It's kind of been a slow, steady trickle. And despite the monumental moves in bond yields, we've yet to really see any sort of sudden exodus for the door like you might expect out of it, particularly high yield bonds. So this is monthly flows into bond funds, both on the high yield side, which is the dark blue, and then the light blue, which is the investment grade. So here lately now we're starting to see some big outflows out of those funds. That is normal and something that we would expect. We have seen, just like on the stock side, the high yield bonds, even more so than high grade counterparts, beginning to create a little bit of spread opportunity. So interest rates and yields have gone up on treasury bonds. They're beginning to go up by more on high yield bonds, something you would totally expect. But as those losses accelerate, you can start to see these bond outflows, which can be some sort of a self-fulfilling prophecy. And at some point in time, will create a really great opportunity to increase exposure to that area, something we haven't wanted to own a whole lot of for the last several years because there hasn't been a whole lot of yield. But eventually enough investors get scared, pull out of those funds and create some really sizable opportunities. And we'll have our eyes open. I don't think we're near that point yet. But it is interesting to take note that the people are starting to finally really pull out in droves out of that sector. So that's the bond side, Andrew. Grocery store stocks, which is kind of surprising. I saw this chart from you. And so I'll let you take it from there.
Yeah, I think inflation's the topic that we're constantly hearing about, whether it's in our market curve or on the news. Filling up your gas tank, going to the grocery store, we're always seeing prices increase. And what's interesting as we come out of the first quarter and we're wrapping up the second quarter, hearing what corporations are saying, hearing what companies are saying on their earnings call as far as their kind of insight into specifically how consumers are being impacted by the rising costs. One place that it's very hard for them to pass on rising costs is at the grocery store. So the consumers are a little bit more sensitive to how much things cost, where they'll just outright not purchase certain items if the price gets to be a certain level. So looking at grocery store stocks and hearing what they're saying on their earnings call can be very insightful. The reason I bring this up now is Kroger, for grocery store we're all probably familiar with, released their earnings announcement and came out and saying that their consumers are aggressively switching to store brands. They're noticing a shortfall in their own profit margins. And they're actually seeing an overall drop in basket size, the amount of items that people are purchasing. Kroger's stock saw a 9% drop, one of the largest on record for them. And you can see here a chart looking at several other grocery stores: Casey's General Store, Albertsons, Walmart, Costco, Kroger, Sprouts, and then Target there. And I also plotted then on the bottom is crude oil. And so I'm looking at this chart from April 11th. Through the last week. And that's when crude went from being under $95 and then went up to $122. Using oil prices as kind of our barometer for inflation, since we get a data every day for that. And we can see during that time period that a lot of these grocery store stocks, I'll bet the Casey's General Store, all of them were underperforming the market. And this was during a time where the market itself was going lower. Why that's interesting is typically we see consumer related stocks, consumer staples like these, actually traditionally do better than the market when we were in kind of a risk-off environment like we were since April 11th. And so it's interesting to see that because of the impact of inflation is having on consumers, many of these stocks are starting to get pinched. And so looking at it from an economically standpoint, we can see that since 2019, we've actually seen the amount of money in bank accounts actually increased by about $3 trillion. The caveat there is when we break it down by income, the top 1% saw their savings and their bank deposits actually increase by 6.5 times. The middle class, 40 to 60 percentile, by four times. And then we look at the bottom 20% of income earners, they actually saw their savings rates drop about $13 billion. And so we're seeing that a lot of Americans in the lower income portion of our consumer base is actually has less savings than they did in 2019. And then we look kind of across everyone, the general savings rate in general actually has gone down as well. The actual savings rate now for Americans is 4.4%, which is actually the lowest since 2008. Traditionally, it sticks around 6 to 8%. And so we're seeing that the savings rates are dropping. We've talked in the past about how credit card spending has gone up, and we're actually seeing now credit card interest rates are rising as well. And so we're seeing from different angles the impact inflation's having on consumers. And then today we're specifically looking at grocery stores and how they're handling and kind of the insights they're sharing on the rise in food costs.
Yeah, thanks for the groceries stores. And that's just been true through all of my cycles. That's been a great place to hold out. 2008 comes to mind where that was a great place to be and hunker down. And just so many things about this environment has been unique. So that one of the charts we've all been waiting for, I know for myself, but 52-week lows and just waiting for some sort of sign of a transition here. So what are you seeing in terms of the 52-week lows?
Yeah, so there's a lot kind of going on in this chart, but it's pretty simple. The part we're going to look at is that middle section, the percent of the S&P 500 that hit a new 52-week low in the last 5 days. The bottom red portion is just the number we're hitting on every single day. Last week was a pretty big week for 52-week lows. Almost 80% of large cap stocks during that week hit a new one-year low. That's quite a bit. If you look at that chart, that's going all the way back to 2002, and we haven't seen this level of new lows reached very many times. Saw it in 2011, saw it during the financial crisis. What this is telling us is that a lot of stocks are already very low. Actually, only 26% of stocks are still within 20% of a 52-week high. And then when we look at that figure, since the COVID crash, we bottomed around 7%. Financial crisis, that figure got down to 2%. And we've actually now at 26%, we're actually less stocks are within 20% of a 52-week high than during the last kind of major decline outside of the COVID crash in 2018. And so we really are seeing a lot of selling. Traditionally, this is where we start to think we could maybe start seeing a bounce. We're seeing that a little bit this week. But a lot of these counter trend rallies that a lot of people are really eager to jump into often begin to get sold. So we're always going to be cautious when we start seeing stocks rally. We want to see some price confirmation from some of our internal data and different indicators that we watch, because a lot of these can be pretty whipsaw when you see these counter trend rallies. But right now we're seeing a lot of stocks are hitting new lows. Maybe we're really eager to start looking for some opportunities. Looking out of the next couple of weeks, we do start getting into earnings season for Q2. And like I talked about with Kroger, also like Walmart and Target, all discussing the consumers being pinched, we expect that likely will probably continue on into Q2. And so as we start getting into those earnings announcements, that may put some more pressure on equities on to the downside. But right now we are seeing a lot of stocks hitting those lows, and this can cause sometimes a counter trend bounce where just the market gets a little uneven. Too many sellers often causes the market to the fact that there's just no one left to sell because they already have, and we see a bounce higher. We just want to see how long will that survive, and will that be durable? If it is, then we're eager to take advantage of it. But at this point in time, we think it likely will just be a short-term bounce that may see another low follow from there. But we always keep an open mind, and as you very well know, we stay data dependent with our investment adjustments. But last week, 80%, pretty big figure, Adam.
Yeah, finally starting to see some of those extreme readings, something that I've been missing. So as always, as well said, and also in generalities there that we're still sitting on mostly a defensive position. Sometimes we have to be very careful because we've got 8 different strategies and everybody's a little bit different. But broadly speaking, we're comfortable in saying we're on the defensive side, and that's just how we'll be until we see things adjust, see the risk barometer shift, or some sign that the opportunity is there. But day by day by day, there's things that are appearing attractive. We're just waiting on the signs for them to show that they're worth buying. So thank you, everybody, for giving us a few minutes of your time. You feel free to give us a call. And if you're concerned about things, even if you had your family update early in the year and just want kind of a refresh on where you're at and confirmation that you're still within the bounds of your financial plan, I encourage you to come in, see us, talk to us. That can go a long way. 800-928-4001. And then also don't forget our weekly radio show on WIBC over the airwaves or through podcast, however you get yours. So once again, thank you and have a great weekend.